Here are the three most common long-term financing options for real estate investors. Number one, traditional mortgage loans, also known as conventional mortgage loans, are home loans that are not insured or owned by the federal government, and 75% of all home loans are traditional mortgages. These are typically obtained through banks and credit unions, which are primarily focused on the borrower's ability to repay the loan and not necessarily the property's ability to service the debt. Traditional mortgages typically have the most competitive rates and conditions, but most lenders cap you out at 10 traditional mortgage loans. The second option are government-backed loans. The most popular government-backed loan is the FHA loan, but there are also two other types of government loans worth noting. One is the VA loan, which promotes affordable home financing for veterans, and USDA loans, which promote affordable home financing for rural areas. Again, all of these loans are government-backed loans, and they are intended for owner-occupied properties, which means they are written with the understanding that homeowners will live in the properties at least for a period of time. These loans have the benefit of lower down payments and low interest rates. When you combine FHA financing with investment strategies like house hacking, where you buy a duplex, live in one unit, and rent out the other, it can combine with FHA financing as a great opportunity for new investors to get started investing in real estate. And while you can have an unlimited number of FHA loans in your lifetime, you can only have one FHA loan at a time. So as you scale the number of rental properties you own, you'll start maxing out the previous debt products I just listed, and you're going to need this next pool of debt products called DSCR loans. DSCR loans stand for Debt Service Coverage Ratio loans. Unlike the last two loan options we just listed, DSCR loans are specifically built for real estate investors. These are non-owner occupied investment property loans that are typically owned by investment firms, insurance companies, and even some banks. These loans are underwritten to determine the property's ability to service debt as opposed to the borrower's ability to service the debt. The interest rates and fees associated with originating these loans are often higher than the previous two options just discussed, but they come with the benefit of still being a 30-year fixed rate mortgage, and a single borrower can obtain an unlimited amount of DSCR loans. I'll add a bonus piece here in because I think it's a story worth sharing. I recently attended a Real Estate Investors Association meeting here in Greater Cincinnati, and a gentleman by the name of Ralph was there. Now, I'm not sure how old Ralph is, but let's just say he's on the fourth quarter of his life. Ralph had accumulated over 200 doors and is sitting right now around 150 doors as of this time, and he never once had gone to the bank or a DSCR lender to get a mortgage. All of his deals are seller finance deals. Most of them are deals where the property owner financed 100% of the sale price and Ralph took it over from there. So in honor of Ralph, let's talk about seller financing. All of the other loan options that I discussed previously have predetermined rates, loan to values, criteria, you name it. But with seller financing, you can make up whatever terms that the seller is willing to give you. So in theory, you can convince the seller to give you 100% financing, a low interest rate for 30 years, even if you have a sub 600 credit score. So that's it for this video, you guys. If you've watched this through to the end, then I hope you've gotten a good sampling of what you want your real estate capital stack to look like. And if you're running out of capital from traditional mortgage loans, then you have a direction on where to go for your next capital.